Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Monday, February the 13th, and oil markets are opened in Asia a little bit down this morning, sobering up the morning after the night before, so to speak, of the Russian sort of unilateral cut to their production, cut in quotation marks. Ultimately, that was seen a quite bullish move on at the end of last week, and on further reflection, looks like maybe the market forgot they had already priced it in. Let's kick off this morning with Omar Najia, Global Head of Derivatives at BB Energy. Omar, your thoughts this Monday morning with the dollar a little stronger, oil a little weaker, and the equity markets at least seem to be sobering up to the fact that actually interest rates could go higher. Your thoughts?
Yeah, I mean, I think basically on oil, we still need to, break one way or the other. I think that one will be lower. On equity markets, my opinion in terms of Fed funds rates basically is that they'll go to 6% plus. And I'm bearish on equities. I'm pretty negative about everything, to be honest with you. So there's nothing that I'm particularly bullish on. So negative across the board. And what can I point to? I mean, I think, bullish news has been factored in. There's not a lot to come. Everybody has, or the markets have a rosy view of what's going to happen. Everybody expects a quote unquote soft landing, like some kind of, slow flake coming down, interest rates kind of go down slowly like a snowflake falling, and markets stay, bullish and robust and all this kind of stuff. So I'm quite negative. I think lower. If I needed to protect anything on oil, I'd do that about 86, 82, 60 something, the recent highs we just had. And I think, we need to tumble. I think we need to tumble across the board.
Bora Bariman, Managing Partner at Hormuz Straits Partnership, sitting in London. Bora, your thoughts on where we're at with, I mean, it seemed that the beginning of last week, we had the Fed speaking again, Fed Chairman Jerome Powell. It's like, oh, great, the party's still going on. He's a bit of a dove now. And as the week went on, it was like, oh, actually, once I listened to what he said, it was quite hawkish still. Your thoughts on the hangover of the recent Fed meeting and the subsequent speaking of Fed officials on this direction of travel?
Yeah, it was an interesting set of messages coming out of Jay Powell's mouth. He referred to disinflation. What was it? 11 times, I recall, in his announcement on the 25-point rate hike, and that left the markets scratching their heads. Are we fighting disinflation, or are we fighting inflation? And I think that's kind of the origin of these of the amplified volatility we're seeing. It's caused by battling policy narratives, and we're in this, I would say, chronically uncertain market outlook. One day the equity markets may be complacent about inflation. They rally as they expect that the Fed and central banks will back off and settle for, higher single digits as a norm. But the next day, they come tumbling, reeling back when the Fed says they're committed to their 2 to 3% inflation target. And we all have our views on that. Personally, I can't see, given the slow growth and inability of Western governments to finance their political priorities through the tax base, that they can really put the brakes on this upper single digit inflation outlook. We're still at 10% in the UK. So I agree with the argument that,
and full employment, by the way, are close to it, as it is in the US. I mean, it is a very weird duopoly together.
Exactly, and that underlines the argument, which I tend to agree with, that we have loose financial conditions today that will not curtail the persistent inflation, given the massive monetary expansion we've seen since COVID. And as you said, Joe Biden could point to record low unemployment and a commitment to stick with funding the energy transition and put up trade barriers. It's called Buy America, right? It's trade barriers to implement the energy transition and the Buy America policy, which will impose extra costs on consumers, and everyone's okay with that. So I see that as being kind of an inflationary dynamic. What Omar's pointing to is, the cracks in the foundations, and that could bring things tumbling down. But
let's go to Youssef El-Shamari, CEO and head of oil research at Sea Markets, a senior research fellow at Imperial College London, and a very close OPEC watcher. Youssef, welcome your reactions to Russia's unilateral decision on Friday to cut their oil production by 500,000 barrels a day. I would imagine President Putin would have mentioned that on the phone to Crown Prince of Saudi Arabia, their recent call. But is this expected? Is this a big departure from this unified OPEC Plus group?
Good morning, Shane, and good morning to everyone. I think in January we had a review on oil markets, and that certainly was something expected because end of 2022, it was mentioned by Minister Novak, the Deputy Prime Minister of Russia, that Russia, in response to the price cap, they are going to reduce production by 500,000 barrels. So the move actually here, what we have seen is actually the action. So the plan was already there since last year. But what does that mean is it's, in a way, it could put additional hurdles on how the group will manage its agreements this year. The group is expected to meet again in June, and what we knew from the JMMC that there is no change in production policy. But now, as Russia is unilaterally making its 500,000 barrels reduction, how I just would love to see how will they, if they are planning to increase the production, especially in the second half this year. China is expected to come back opening, and Chinese economy is expected to rebound. So what I would expect is the group is to be pumping additional barrels, especially the 2 million barrels that were cut last year. So at least to bring 500,000 barrels in the second half of this year. So I think it could complicate things a little bit. And the one thing here is that certainly OPEC Plus is there to stay. And I don't think that the group is willing to keep Russia away from its agreement. They want to have Russia continue to be on board even beyond the 2023.
And do you think, does this in any way jeopardize that, or would you understand that this was not a unilateral action and it wasn't a surprise, and so for their fellow OPEC Plus members who are probably appreciate the extra little bump to oil prices, nonetheless, this would have been expected, signaled, communicated, and nobody's left thinking, oh, are we now longer in agreement?
Well, I think there will be two scenarios, Sheen. The first scenario is because there is expected slowdown in the economy, especially in the Western economies. So the latest news of the cut did not really, the markets really didn't react significantly. So if that scenario continues, especially in the first half, I think the response from the group, there will be no response. So that is, the Russian cut will have no impact on the markets. But I'm worried that if when China comes back in the second half of this year, or maybe slightly before, and how will they be able to manage any production agreements, especially production increase agreements? Certainly, in a way, it's kind of shows that there's a slight divergence in terms of the interest of OPEC Plus and Russia. For how long that divergence will be, especially if the war continues and it gets further and further complicated. So also, for how long Russia will continue with that policy, for how long will the cuts be? Still, there's no clear announcement if the cuts is 1 month, 2 months, or for the whole of 2023. So I think it adds an additional factor of complexity into the OPEC Plus agreements.
Omar, despite all this noise and the Russia move and other things, the Fed talk last week, we're still back at kind of $85 on Brent and $79 or so on WTI. This is a market without any real direction up or down. It does bounce a little bit with these little noises, but ultimately there's no clear direction now. Where could direction come from?
Well, I think basically, look, the market can stay like this for a while, but I think it's kind of fighting against gravity or reality or sanity, if you like. Okay, if you look at the big picture, okay, first of all, China coming back. China can only come back once, right? They can't keep coming back and coming back and coming back. So put China aside. It's coming back. It'll come back quicker and come back slower. It's really going to come back, whatever. But I think China's coming back is already factored into everything. That's one. The second thing is, if you look at the US, you're seeing basically the what do you call it? The interest rates, the 2-year, 10-year inversion of that curve. That's basically at its most inverted since 1981. Now you can stick your head in the sand and say, this time is different and it doesn't matter. Just like we said, when we print all this money, it doesn't matter. But I think that's going to come back and haunt the markets. Another interesting statistic I read is as interest rates, now at 4.5%, and we think they're going to go to 6% plus. But let's assume basically they are where they are. If you look at like these are, widely quoted statistics, 20% of US firms, 20%, need to issue new debt to pay the interest on debt they already have, not to basically invest somewhere. They need to issue new debt to pay for the interest on the old debt. Now, if that's not telling you something, I don't know what will. So all I'm trying to say is, it's like that cartoon, the Wile E. Coyote, Roadrunner, and all that kind of stuff. The coyote can run over the cliff, and he can, keep going and going and running on thin air. But at some point, gravity is going to have an effect. So I'm not trying to be like doom and gloom, but I'm saying that from what I see in terms
that's
of
Nouriel
markets,
Rubini's job.
Yeah, exactly.
Dr. Doom.
But yeah, exactly. But I think basically that I can't see very many reasons to be bullish or to put money into these markets at these levels. If the markets were considerably lower, if WTI wasn't trading at 78, was trading at 50 or 40, if the S&P wasn't at 4,000 but closer to 3,000 or 2,500, then yes. But at these levels, I don't see where the upside is going to be. I still say that risk is massively skewed to the downside. So there's absolutely no point. If you put your money in treasuries for a year or a month or whatever it is, you're getting 4.7%. So why should anybody risk anything?
And if you go to AAA corporate bonds, you're probably getting 6 and 7%. Bora, clearly the sort of the analogy of the bird running off the cliff, it keeps on running, is there, but yet Europe, the sort of the epicenter of doom and of expected doom and gloom, war in Central Europe, energy crisis, and yet we're still not, we still have growth. There's no energy crisis. Employment is still really high. In Germany, they're struggling to fill. There's more empty jobs than there is unemployed. I mean, where is this crisis? And perhaps we have to accept that there's actually still quite a bit of land under this bird, and he hasn't gone off the cliff yet.
I was listening to Jeremy Hunt sort of make his statement that
The optimistic face of doom and gloom, Jeremy Hunt.
it wasn't quite optimistic, and I think
Okay.
they do have their finger on a political pulse because it kept acknowledging pain on the high street, pain of working families, inability to deal with the cost of energy, the cost of food. That's there, and I think again, I keep repeating myself. I sound like I keep saying this K-shaped recovery. We're in this K-shaped world where, yes, there's equity markets and they are rallying based on their outlooks for inflation and interest rates. And it's just kind of a game with all the money sloshing around. But then there are people living on close to minimum wage, and that's half the society. And I think that's where the instability could come from, and a political uncertainty can come from. I mean, we have to recognize that, yes, Europe has not, collapsed under the energy pressure of the war, but there are still people burning trucks on the streets of Paris, right? And overturning cars on the streets of Paris. And that sentiment, I think, is not unique to Europe.
The cafes are full, but there's still people burning cars on the
exactly.
streets.
Who can afford £4 Starbucks? But some people can, and their view.
And apparently it'll still be 10% more expensive next year because inflation in the UK and Europe is still at 10%. So you have to expect that if the ECB is going to fight it and the Bank of England is going to fight it, as they say they are, then rates are having to go a lot higher.
Rates will go higher, and that will destroy the economy. If the economy is coming down, then the question is, will they pull another 2009? Will they pull another?
10% inflation is going to destroy the economy. So you got to choose one or the other. Your money's actually worthless, or the economy is struggling. Yusuf, clearly where things are not struggling, according to the Saudi OSPs into Asia, which jumped for the first time in 6 months for March delivery. There's a lot of optimistic outlook for Asia, at least it would appear in those pricing. How do you read the Saudi OSPs into Asia for March, which actually caught most people by a little surprise?
Well, I think it's a response to an expected increase in demand, especially coming from Asian refineries. That includes, China here is the biggest factor, but also India, because as we know, the 80% of Saudi oil exports go to Asian refiners. So with an expected increase in deliveries, because as you know, the most of that demand will come from refineries who will need to produce much more fuels, and that's how Aramco usually reacts to its pricing decisions. So what would that also mean is the incremental or the hikes in OSP has also come at a time where OPEC Plus is keeping its production steady. So in a way, it gives Aramco a economic advantage because it's selling less crude than what's the market is actually.
But is there not a risk there, Yusuf, a little risk? I mean, this is the sort of bigger question that given the amount of Russian oil now flowing into China and into India and Asia, that with the more expensive Saudi crude, that the likelihood is that the Asian customers might just take the minimum they have to take in their term requirements and go for the cheaper discounted Russian Iranian. I mean, is there, as we go forward, that these flows get bedded in, that Russian Saudi alignment could be come under a little bit of competition and stress?
Well, I still don't see a competition scene. The reason is the contracts between Saudi Arabia and Asian refiners are very much long terms, while Russian diversion of oil has been just recent, and it is expected. It's not known for how long these diversion will last. Also, the amount of oil that Russia can divert to Asia is not expected to be as much as how much Saudi Arabia can divert, because Saudi Aramco is actually the largest baseload provider for Asian refineries, and the contracts there are pretty much very much long term. In fact, as you know, China is expected to go net zero by 2060. So until that period, Saudi Aramco is expected to be the largest provider of hydrocarbons. So that's the first reason. The second issue here is that Russian oil is expected to fill stocks in China, because China used to already import oil from Saudi Arabia, given the contracts that they have already signed with Saudi Aramco. So I don't expect that Russia will become a competitor for Saudi Aramco at this stage. Certainly, they can, let's say, get some of their oil into Asian refineries to fill stocks and also to get it at a much, much cheaper price. But I don't think they will be the main competitor, just due to the fact that the long-term contract that already signed with Saudi Aramco.
It's I suppose time will tell in terms. I mean, we already have about 3 million barrels of Russian oil making its way into Asia now. Up to 30% of India's daily oil imports coming from Russia. These are very significant numbers as time moves on. We'll have to see. Let's go to the survey question, and on this question of Russia's oil cut will have little impact, as the oil markets had already priced in a Russian disruption of up to 1 million barrels per day. Agree or disagree? Russia's oil cut will have little impact on the oil markets when all's said and done, as the markets have already priced in a Russian disruption of up to 1 million barrels a day. Omar, I suppose the question here is, again, just sort of wrapping up with this Russian move, as was with gas, the gas sort of face-off with Europe and the West started with little incremental cuts, and the sort of eventually the natural gas exports from Russia to Europe ended the year practically near zero. What's your outlook for this being the first salvo in a Russian oil weaponization, if you like, and that we could see more of these?
Yeah, no, I think basically, look, there's a little bit of a misunderstanding, right? So now with all these sanctions and oil products, so what you were saying was that India's import of Russian crude is skyrocketed. The reason for that is that so you can't sell, let's say, a cargo of gas oil very, very simply to Europe from Russia, because it's too expensive, price cap, whatever you want to call it. So basically what the Russians are doing, they're selling the oil to India. India are taking that oil, refining it, and selling those products made from Russian oil back to Europe, only at an inflated price, which is not price capped. Okay, so all you're doing is you're not actually taking something away. All you're doing is you're changing the flow, right? So Russia sells instead of Russia selling products directly to Europe or the US, Russia sells to India. India refines the oil and then sells those same products to Europe or the US. Okay, so all you're doing is changing where it's coming from, how long it takes, shipping, all that kind of stuff. You're not really changing. There's not like more demand in the East now, all of a sudden, and less demand in the West. It's not. It's basically flows. But when people look at it, they say, look, it's going up, so there must be more demand. It's not. It's basically flows. So the market is, quote unquote, balanced. There are no shortages. Same with gas. They say like gas, Germany hasn't bought any Russian gas since whenever. It's not true. So the gas goes to Hungary through pipeline. Then they re-export it, or it goes through Ukraine, which is still, Russian gas is still flowing through, et cetera, et cetera, et cetera. It's just, it doesn't go directly. So instead of Russia selling directly to Germany, it goes through Hungary, and all of a sudden it's not sanctioned and not that. So that's one. Second of all, is markets tend to work, they look forwards and they panic. So what we had before was a panic about what's going to happen to Europe. Now that panic is basically subsided. We're going to get another one as we come towards the next winter in 2023, right? But right now it's not time to panic. The emotion in the market is flat. So you got to see which way this, but I think basically the only way that the market can make money is if everything dumps and then you buy it as you go into winter with another mass panic. So if everything dumps, politicians will come and say, oh, it's solved, everything is fine, blah, blah, blah. And then people come in and start to feed. But prices
Don't
at this
panic.
level.
Don't
Yeah.
panic, Captain Mannering. Don't panic.
Yeah, exactly.
Greatest show
Exactly.
ever, Dad's Army. Any chance to quote Dad's Army? Bora Barryman, Dad's Army in Europe, of course, that's what it was there for. Keep the Germans out of the Great Britannia back in the day. But reaction to this Russian move, when the gas weaponization happened, quote unquote, last year, Europe was going, oh my God, this is like every headline, every news organization was freaking out. On this occasion, Russia's unilateral cut of oil seem to have little disruption, little noise making in Europe. Your thoughts on where it reads, obviously from a European point of view, if this was indeed the first of maybe many potential Russian cuts to weaponize oil?
I think that there should be concern. I think there should be concern, and the concern is reflected in the boardrooms, as we've all seen of the big oil companies, and clearly they see this decarbonization or pivot to renewables perhaps has been over egged, and they are focusing on security of supply for themselves. They are Western international majors. They want to remain relevant, and they see that it's profitable. So I saw a political spat in Italy between Enel and Meloni, and she was having a very harsh go at them for that. And she said, we need to secure hydrocarbons for our industrial base. And I think the kind of mood music is shifting in that regard. There is a acknowledgement that energy is strategic, and what's more, let's look at the growth outlook that the IMF and the markets are giving to us for 2023, and anything above 1.9%, that's in Asia. India, Vietnam, Indonesia, China, even Turkey was before the earthquake projected to grow 3.3%. So Europe must be taking note, and energy is fundamental to growth. And all those high growth economies are getting the hydrocarbon from Russia, aren't they? It's at discounted rates, which are a great boost to their economies.
Absolutely. Yusuf, last word for you in terms of this idea, Russia's oil cut, little impact, at least this room tends to agree with that statement. We'll post that on social. If Russia was to do this a second time, Yusuf, would that be a lot more stressful for OPEC Plus? You get one free shot, but
stressful. It is already stressful, in my view, at least seen. Although I certainly agree that OPEC Plus would perhaps want to disregard perhaps the decisions taken by Russia and continue with the momentum of the agreement, because the most important thing for the group now is to keep the alliance. But I think the further that escalates, it could complicate things further, especially if we see a market reaction. So far, the reaction from the market is almost mute. But if we see prices jump to maybe $100, so then I think things can be a lot more complicated. But for now, I don't think it will really affect the coherence of the group.
I suppose if they were announcing an increase, that might get the group a little bit more frenzied. A 500,000 barrel a day increase would be a whole different story. But if you're cutting, well, we can live with that. Bora Berryman, thank you so much from London. Omar Najia from Dubai, and Yusuf El Shamari, I believe from Saudi today, although I'm not, yes, in the kingdom.
Yes.
That's great. Lovely to have you. We're opening the week with oil settling a little bit down. Brent down 1%, similar with WTI. We'll see where the week goes as the markets absorb this decision by Russia and this growing realization that the Fed could be raising rates higher for longer. Thank you. All the best. Bye-bye.
Thank you.
Thank
Thanks.
you.